Most people's biggest investing fear is that they'll lose all of their hard-earned dollars. And if you invest at the wrong time, that's very possible. A market crash could wipe away your wealth. That means that you'll have less saved, you'll be further from your financial goals, and you might have to work years longer to reach financial freedom. And this isn't just a hypothetical situation. It actually happened to me. In the very first year of my career, I lost thousands of dollars in the stock market. This is a graph of my actual returns. I lost a lot of money. Had I put in $100,000 at the start of the year, it would have been just $76,000 at the end of it. A lot of investors think this is the worst case scenario, but it was actually good news for me. I'm actually hoping that the stock market crashes this year too. And no, that's not because I want to watch the world burn. A stock market crash would actually make it easier to reach financial freedom, which is something I'm on track to do before I turn 30 years old. But very few people understand this. So in this video, I want to explain why a stock market crash is such a good thing if you do what I'm about to tell you, when a stock market crash is actually really bad, and how to ensure a stock market crash doesn't ruin your retirement plans. I've spent hours and hours researching this topic, and I captured all of the most important points in a free downloadable guide. That's the top link in the video description if you're interested. Part 1. Why I hope the stock market crashes. There are very few people that understand what I'm about to tell you, but the people that do understand this make a ton of money because of it. But for this to make sense, you have to understand how the stock market works. So give me like 20 seconds to explain it. When you buy shares of a company stock, you are literally becoming a partial owner of a very legitimate business. This is not gambling. You literally own a real company that creates value and earns revenue. I know that the stock market feels super abstract to a lot of people, so if it's easier for you, think about being a partial owner of your local grocery store or even of a real estate property. It's all the same concept. And that's why investing in the stock market is fundamentally different than buying Bitcoin or any other cryptocurrency. But I don't have time for that rant right now. The real point is, when you invest, you own a real business. For the purposes of this video, that's everything you need to know about the stock market. So now, let's say you take some of your savings and invest, and with it, you buy 1% of Amazon. By the way, if you could actually afford to buy 1% of Amazon, you don't need to be watching this video. This is just an example. And what I want you to understand is that whether the stock market goes up or down tomorrow, you would still own 1% of Amazon. And that's really important because it tells us that there are only two times that the value of your shares matters: when you buy them and when you sell them. Ideally, you want to invest in shares when they're low and sell them when they're high. And since the stock market is made up of very legitimate businesses that are constantly growing, they almost always increase in value over time. But 99.9% of the time, the value of a stock doesn't matter at all. You're just going to let your investments keep growing without touching them. So do you see why a stock market crash is such a good thing? If you're investing for the long run, it just means all of your favorite stocks are selling for a discount. That's going to make it so much more likely that when you do want to sell in the future, the value of your investments has gone up. As long as you don't need to sell your investments anytime soon, and you have more money coming in that you can invest during the dip, then a stock market crash is awesome news. It just means that your next investments are even more likely to be super profitable. As long as you buy during a stock market crash instead of sell, you will become wealthy from it. But of course, the stock market crashing can also ruin fortunes. So let me explain when you don't want the stock market to crash and how you can protect your investments if it does. Part 2. The worst time for a stock market crash. Imagine this. You've worked a long, hard career and you've slowly saved up a nest egg of $1 million. You think this is enough to cover your annual expenses of $40,000 per year. So you quit your job. But the day after retiring, you wake up and see that the stock market has dropped by 20%. You now just have $800,000 to live off of instead of that $1 million, which is just 20 times your annual expenses. Unless you can spend even less money, it is far more likely that you'll run out of money in retirement. And you know that the stock market will go up eventually, so ideally, you just wait for your shares to recover their value. But since you just retired, you have to sell some of your shares just so you can live off of them. And even worse, you can't buy any new shares at their discounted price because you just quit your job. You don't have any new money that you can invest. That's why the very worst time for the stock market to crash is the day after you retire. So the reason I'm hoping the stock market crashes is I'm still early in my career and I have a steady source of income that I can invest. I would be a lot less excited about the stock market crashing if I was planning to retire soon. Or even worse, if I'd already quit. But of course, the stock market will crash eventually. If you're planning for a long retirement, you need your retirement nest egg to be able to survive those bumps. This is especially true for me because I'm hoping to be able to retire before I turn 30 years old. I could be looking at a 60-year retirement. At some point in that time frame, the stock market is going to crash. But this isn't necessarily a huge issue. As long as the stock market doesn't crash as soon as you retire, then you'll have time for your investments to grow and build up some padding, as long as you only withdraw a reasonable amount of money from your retirement nest egg. Then, when the stock market inevitably crashes, you can live off of the padding without having to reduce your standard of living. But if the stock market crashes as soon as you retire, then the strategy will not work. You won't have any padding built up to take that hit. So to absolutely make sure that your retirement is not ruined by a stock market crash, we have to take a different approach. Part 3, the yield shield. The yield shield is a strategy you can use to protect your retirement even if the stock market crashes as soon as you quit your job. To see why this works, remember that your investments own real businesses. Most people invest in these businesses in the hopes that these businesses will increase in value. They want to buy low and sell high. But this is not the only way to invest. You can use a completely different approach, because some companies might not be growing very quickly, but they might still be extremely profitable. So by owning a fraction of that business, you are entitled to a fraction of those profits. This might make more sense with a toy example. Let's say you have $1,000 to invest and you're choosing between two businesses. Business A is growing quickly, so it's reinvesting all of its profits in growth. It won't pay you anything as a partial owner, but you expect the company to grow by 10% next year. Business B is not growing quickly. Since it doesn't need to reinvest its profits in more growth, it pays out those profits in the form of dividends. Next year, you expect to make $100 from your $1,000 investment. In this case, both of these investments have a 10% return on investment. One has a 10% growth, while the other has a 10% payout. But if you're nearing retirement, you might choose to invest in Company B. That's because dividends are typically more consistent than growth, and the companies that pay dividends are typically more stable in the event of a stock market crash. Over the long run, Company A might have been the better investment. It might grow extremely quickly and become super valuable over the long run. But Company B might give you the safety net you need to retire without worrying about the stock market crash wiping away your nest egg. So how do you actually use this strategy? Well, there are actually a number of ways that you can use to boost the yield of your investment portfolio. Preferred shares, high dividend stocks, and bonds are all investment assets that will pay you to own them. Again, these investments might not go up in value as much as some other assets that you could own. But since they pay you on a consistent schedule, they might be way safer. This investment approach is called the yield shield because these consistent payments can make your investment portfolio way less risky. So even if the stock market crashes, you could still be earning a significant amount of money from your investments. That gives you the money you need to live off of without having to sell your shares. And once you've gotten a few years into retirement and your other investments have built up some padding, you can transition away from the yield shield and invest in long-term growth again. And by the way, huge shout out to the Millennial Revolution blog, which is where I first learned about this strategy. And I just gave you a ton of information in this video, and I know that you aren't going to remember everything that's important. And that's why I put in the extra hours to make a complete downloadable guide that includes all of the main points and will even link to some additional resources. That's the top link in the video description. So if you like money, make sure to grab that. It's literally free. And now you know why I was so happy that the stock market looked like this during the first year of my career, and why I've been so bummed that it's looked like this ever since. I really do hope that the stock market crashes this year, even if it means I'll have a much lower net worth. But there is one question that I haven't answered in this video yet. How much money do you need to have invested before you can safely retire? This is one of the most important questions there is. If you overestimate, you could work years that you didn't have to. But if you underestimate, you might save too little and have to go back to work even after retiring. So to help you figure out what you really need to save before retiring, I made this video right here, where I explain one of the most important rules of money there is, and a few common mistakes that could wreck your retirement if you're not careful. So check it out next.